Let's steer away from the legal, because international law is also a bit of a dangerous topic in these modern times, especially for a Dutch blunt guy like me. Let's talk money to make it less sensitive. There's quite a few questions popping up on the cost of the solution. And perhaps first I can steer to you, Emre. Implementing this kind of solution, what kind of cost do people working with? And you're still muted.
Again, our approach was a little bit different from the legacy platforms. Coming back to cost, we decided to charge our customers based on 2 points. One is we don't charge them for integration. None of the banks, none of the corporates has to pay anything. So coming back to your Barış's question, in the company of Şişecam, we had procurement teams totally involved into the process, and also the IT team is totally involved. And we didn't charge them anything on any of the solution that we provided. So our fee is based on executed transactions, which is important. The second point, our approach is, as I said, we sit down with the corporate and try to understand their key performance indicators. What are you trying to achieve? Is the receivables and payables are a joint solution? Can we do something like that? Or is it the payables, or is it the only receivables? We look at that. So whoever pays the cost has to have a benefit. If it's the main company, which usually Şişecam comes with certain strategy, but also the supplier will have a strategy. So our platform allows, for example, in this case, Şişecam, apply different pricing to different supplier groups, different markets, different tenors, depending on the cost in Turkey. So we are using Dominic's technology, Flownote technology. Let me pull it, the Flownote platform, by using that experience into Europe. So it's a totally flexible cost structure, and we only charge whoever gets the benefit based on accepted transaction, not rejected, from the supplier or buyer, depending on the KPI. Sometimes the buyers pay for it because it fits to their strategy in terms of having suppliers, sustainable supply chain and everything. There can be certain group of suppliers which are key for their production, and they want to support them, and the cost is not passed on to the suppliers. But in certain cases, suppliers require early funding, so the supplier pays. So our platform is flexible, as Dominic pointed out, in terms of how to apply it to different groups, different banks, different funding structures. So we don't charge anything for implementation, integration, and so forth.
Those who are interested can reach out to you and Dominic, and in essence, if you don't get a solution, you don't pay. That's more or less what's there. And 2 questions for Barış, or first one is it's also from the audience. Are you willing to say something about the pricing of the financial services providers out there, the banks or other financial services? Does this solution influence their pricing, or is it as is?
I can easily say that the pricing is cheaper than the bilateral credits, because it is, as my peers are knowing, that the banks are knowing where is the money going. So it's a trade finance, which cheapens than the bilateral credits, to be honest.
Nice.
And also the issue is about the pricing. Logically, the discounting order or transaction comes from the supplier, and the banks takes the buyer's risk.
Yeah.
But at the end, as the bank solves the trade, so all the trade is transparently shown, even the invoice details. So it helps the bank to cheapen the financing, I guess.
Yeah, get it. Yeah. And I invite all. Yes.
If I just add in, one of the reasons for that is, unlike invoice finance, where, as many on the call will know, the financiers have to take into account, potential rejection of the invoice for sort of non-delivery or non-performance. So although the payment risk is indeed on the buyer, there is inherent supplier risk in that. The legal separation with a working capital note removes that element. The note is a separate legal instrument from the invoice. And that therefore means two key things alongside hopefully attractively priced finance. It means that most lenders will finance between 95 and 100% of the note value because they have a enforceable on-demand instrument in their possession. And it therefore solves for that problem inherent within invoice finance, which I call the don't want to pay problem at maturity. This is you pay at maturity, or there's a very quick and actionable legal route for the holder to take to get enforcement.
Yeah, get it. I invite all panelists to go scroll through the Q&A and the chats, because there's quite a lot that we will not be able to answer, and we only have 5 minutes left. But I think one I think the audience would want an answer to is one for I think for Baris. What's the balance sheet treatment? Remain as payable, or is it recognized as bank debt?
For the buyer, it is not bank debt because we just give the promissory note. We are not the part of the financing. For the supplier, it can be a bank debt because they are discounting the financial instrument they have. I'm not 100% for sure, but for us, we give a promissory note for our trade payable, so it's trade payable.
Yeah,
I want to underline that we are not a part of the discounting part. We just give the promissory note. Discounting, in this example, it is İşbank because our supplier's bank was İşbank. But mostly the supplier decides where to discount and the discounting rates. We are not a part of it as a buyer.
Yeah, get it.
So we are, as the platform, getting from the SAP system of Şişecam their payment data, and then we are making it with ETR Digital. We are making it a transferable, digitable, enforceable asset, and then allowing banks and suppliers to use it. So in a way, that's the summary of the solution.
Yeah.
This
Well, I also think it connects to I think a majority of the people in the audience are treasurers, and there's the whole discussion of cash is reality and profit is an opinion, and all kinds of those jokes are going around. But if you have to convince your CFO or your group controller or anyone out there of the treasury environment, there's new wording and there's new KPIs, and what convinces you totally might not be what convinces them. So I think for a lot of these topics are then relevant, I suppose. I can imagine that both Emre and Dominique also encountered that with multiple clients, and I also really see Baris agreeing with this aspect.
Well, and Peter, you mentioned the word KPI, and I would say for anybody listening and planning to adopt this sort of a process, which is really very straightforward, it's make sure you've thought through the KPIs more internally than externally, because to the seller of the working capital note, so typically the supplier, it represented a true sale when Şişecam's supplier sold that instrument. And because of the nature of the working capital note, that could be done on a without recourse basis, because what the bank, Ishbank, our friends at Ishbank were interested in was the fact that they were taking possession of an enforceable instrument, a trade payable for Barris and his team, that they knew would be paid at maturity, at the agreed maturity date. So, you know, I hopefully that answers the sort of a question around who's discounting the issued promissory note. And just to add in, because I know this is a particular point for our friends in Turkey, indeed, it is very straightforward, and our process allows for it, for a bank to add their aval. So, you know, for example, Ishbank can add their aval to promissory notes issued by Sisajam, and those same notes can be then financed by another money center bank, you know, in the London market, or indeed elsewhere. And it doesn't need to be a bank. Certainly avalized notes with Ishbank's imprimatur on them are going to be very readily funded by trade funds, family offices, other providers of liquidity, which is why we reference the fact that these instruments open up much deeper pools of liquidity than hitherto available. Yeah,
and that is an excellent way to wrap up this session, Dominic. Thank you very much for this, because I said I was strict on the 45 minutes, and there's many questions left, which is, in my perception, a good sign. I can't speak for the audience, but I learned a lot, and I love this topic because I think it enables the corporate treasury community to have a way bigger impact and show the value of good treasury. So thank you very much for that, Dominic, Barris, and Emre. Of course, thank you people from ETR Digital and from Treasury Excel. There are many more webinars scheduled, so I hope to see you out there, and also in the treasury events that are now being organized out there with the various suppliers of those.
Thank you.
So thank you all, and have a good day. Bye-bye.
Bye.
Bye-bye.